Hello, and welcome back to our podcast series, Collections Conversations, sponsored by our friends at C&R Software. One of my favorite things about this series is that it separates the casual fintech nerds from the real hardcore fintech nerds. Collections isn't for everybody. It's not glamorous. It's not where you choose to work if your goal is to get promoted quickly. It's complex, operationally, technologically, legally, and it's also deeply human, irrational, messy, highly emotional. But the thing it is above all else is a great place to learn. In collections, you learn the limits of predictive models when they run up against humans trying to make high stakes decisions under stress. You learn how to do more with less because you are always expected to be efficient and you are never given all the resources that you ask for. And perhaps most importantly, you learn the true value of relationships, which in financial services is only something you learn when trouble hits. That's why collections is the perfect topic for true dyed-in-the-wool fintech nerds. You can learn a lot from studying it. Which is why I wasn't terribly surprised when today's guest, Dave Wasik, reached out to me after the first episode in this series was published, expressing his excitement about the topic and offering his expertise. And that was an offer I was only too glad to take him up on. Dave is a partner at Second Order Solutions, which is a leading credit advisory firm. He also spent the first 17 years of his career at Capital One, where, among other roles, he led collections and recovery for Capital One's U.S. card division during the Great Recession. He is the perfect person for the discussion that I wanted to have in this episode. A wide-ranging exploration of how collections has evolved over the last couple of decades, what's new in collections, obviously we talk a lot about AI, and where the low-hanging fruit is for organizations that want to improve their collection strategies and tactics. Put simply, Dave is the best, and this conversation was great. So without further ado, here is episode 4 of Collections Conversations. Okay, Dave, thank you for joining me on this series, and thank you for coming back to the Fintech Takes podcast. You're the man.
No, it's great to be here. Thanks for having me.
Absolutely. It's kind of funny. We started publishing this series, and I think you messaged me after the first episode came out, and you were like, I don't like to broadcast this, but I am like secretly a collections nerd, and I would very much enjoy the opportunity to talk to you about collections. And that's really the purpose of the series, is to like bring all the collections nerds to me. And so delighted to have the opportunity to talk to you and get your perspective on this, which for folks who don't know you and Second Order Solutions, maybe you can give a little context on what you do,
Sure.
and then we'll dive right in.
Yeah, of course. Second Order Solutions is a lending advisory firm, and we work across the lending lifecycle. So helping lenders originate loans, manage credit on existing customers, fraud, collections, and recoveries. We do a lot of collections engagements with lenders in obviously the U.S., but then also overseas as well. And so, I am a not so secret collections enthusiast, and really excited for the topic.
Excellent. Well, I'm excited to have you because we can talk both about the nuts and bolts operationally of collections and how that's changing, which we will talk about. But we can also talk about the broader context in which collections is happening. And I want to start there, actually, because you guys release these great quarterly reports on kind of the state of credit. And you recently released your latest quarterly report. And I was hoping to get just a download on the trends from that report, kind of at a macro level, like home, rent, auto inflation, declining wage growth, savings rate. I'm curious kind of how the macro picture, which is, I think, is a little muddled maybe, but we constantly are hearing about, how is that starting to show up more granularly in delinquency rates and just sort of portfolio performance overall?
Yeah, sure. Yeah. For the last few quarters, we've seen almost this dichotomy where, looking backwards, delinquencies look pretty stable for most lenders in most asset classes. And then there's this juxtaposition where that just seems really hard to believe because of everything we hear about. You mentioned some of the areas, rising home rents and auto prices, consumer confidence at not an all-time low, but at a 10-year low. Just the resumption of federal student loans and repayments of student loans and what that means for tens of millions of Americans. And so I keep thinking, okay, well, this is clearly this is going to be the quarter, or this is going to be the month when things go haywire. But for the most part, things remain stable. In our last report, which goes through the fourth quarter of 25, we saw two areas that I wouldn't call red flags yet. They're more in the kind of yellowish orange variety. One relates to the federal student loan. So, you're familiar with this history, but during the pandemic, there was a 3-year pause on repayments of federal loans. That was followed by a 1-year period of time where payments were supposedly due, but there were no consequences. Credit bureau reporting was on pause. Then it was about a year ago now that there was the grand reveal of, hey, we haven't seen reliable reporting on these loans in the bureaus for several years at this point. Yeah. And surprise, surprise, delinquency rates were breathtakingly high. And what we've seen over the course of, especially the second half of last year, is that delinquency rates are still quite high on student loans, but they're significantly lower than they initially were earlier in the year. The one exception to that is subprime federal student loans, which remain stubbornly high and aren't making kind of the same reversion back to pre-pandemic levels. And so, when you think about the size of those loans and what that means from a monthly payment perspective, I do worry that that might be like the first kind of danger sign we're seeing of like, here is the subprime borrower just under more and more stress, and are they beginning to kind of crack under that stress?
Well, can we pause on that? Because I think that's really an interesting observation, and it does sort of make me wonder, like, what's driving it, right? Because from the student lending perspective, I think everyone who was watching the space, it seemed reasonable to expect high delinquencies, right? Because there was this thing that you didn't have to pay for a long time. And then even when repayments technically started, the data wasn't being reported to the bureaus. And so, like, understandably, from a consumer perspective, you might go, yeah, I know eventually I'll have to get back to that, but like, not right now. I'm doing other things with that money, so on and so forth.
Yeah.
But it sounds like, for the most part, for most segments, like, it has kind of reverted somewhat back to the mean in terms of like, okay, now it's time to actually start repaying these. And like, we're seeing that performance. But with subprime, I wonder if you said subprime federal student loans, right?
Yeah.
I wonder if it's kind of an indicator of, to your point, like, this is one where when we let go of the rope, like, we can't get it back, right? Like, just like that segment being under more financial stress might indicate that, like, unlike other consumers where they didn't want to start, like, getting back to good performance on that, but they had the capacity to do that. Maybe subprime, like, that's an indicator of actual, just like, we truly don't have the capacity to pull this back in. What's your theory about that?
Yeah, I mean, a couple things. One is we are not seeing that same level of elevated risk in other subprime asset classes, right? So subprime credit cards, subprime auto. Of course, it's subprime because the delinquency rates are high, but they're not uncomfortably high or trending worse. And so that's an important call out.
Yeah.
For my entire career, the Department of Education has been the most laid back debt collector in all of consumer lending. And so I wonder, and we have certainly an indication that that will change. There's been articles about wage garnishments, tax refund garnishments.
Yeah, they can be like the worst debt collector if they want to be, right? Like they have that power.
For sure, right? Because they have the ability to garnish wages, garnish tax refunds without a court ruling, and federal student loans can't be discharged in the case of bankruptcy.
Right.
And there's again indication that the administration will begin to kind of flex those muscles. We don't have the sense that they're doing much of it yet. For example, this is tax refund season, and the folks that I speak with don't believe that there will be significant garnishments of tax refunds during this tax year. We do expect, particularly in the second half of this year, that you may start to see more wage garnishments. And I think, oftentimes in collections, the most persistent debt collector is the one that gets paid first. And while we will be at the point where the DOE will start to be a lot more persistent and aggressive, we're just not at that point yet. So I do wonder if that's part of what's kind of making that for a lot of borrowers like a tomorrow problem rather than a right now problem.
That makes a lot of sense. And then flag your second area of concern in the data. You mentioned two. What's the second one?
Sure. Yeah. So when we look at credit card delinquencies, we look at it both in terms of, hey, for the sector, how does the overall category trend in terms of delinquency from a quarter to quarter basis, and then we look at it on an origination vintage basis, which is often the more telling in terms of how are the cards that I'm originating in 2024 performing relative to 23, 2022, even pre-pandemic. And sitting here in February of 26, we're just now getting our first glimpse of cards originated in early 2025. And again, we don't have a lot of data on it, but what we're starting to see is that the trajectory of that vintage is starting to look worse than the 24 originations, worse than the 23 originations, and more in line with the 2022 originations, which was just not a good origination vintage for cards, auto loans, really just about anybody. And so if that trend were to continue, that would be a sort of a reversion back to the late stage COVID era, which was again not a good place for the lenders to be. And so again, it's early. You've kind of got to squint to see it, but we spent some time in the quarterly report breaking that out. And again, that's also one of those yellow-orange flag areas for us.
That's interesting. I mean, credit card is kind of a fascinating space. If we could maybe just poke at that for 1 second, because, I think two things are kind of true at the same time with the credit card market, right? I mean, one is, I think credit cards, broadly speaking, from what I've been able to tell from a product design perspective and an origination perspective, and this was sort of borne out in looking at the trend data in the CFPB's biannual credit card report that they do, right? Where they were talking about the fact that credit cards have become much, much more of a premium product, for lack of a better way of describing it. And so they're like a lot more rewards cards. There are like fewer customers paying annual fees, but the annual fees are higher. And so the overall revenue generated through annual fees is higher. Delinquencies are starting to kind of split more, I think, dramatically between sort of premium cards that are more for your transactor set versus cards that are more designed for revolvers. And at the same time, I think you have to sort of weave into that story the fact that, credit cards are, compared to sort of your average sort of consumer financing tools, in some ways they're kind of like this weird legacy of the way that financial services used to work, more than the way that like products are built today. Like a lot of the newer unsecured consumer lending products are much more structurally safe, right? Where it's like we're underwriting for small pockets of liquidity. And so I guess I don't even know if I have a really well-formed question here, but I'm curious what your perspective is on the changes in kind of the competitive dynamic in credit cards and how that might affect performance of cards. Because for a long time, credit cards were kind of the only game in town, and they bundled so many different types of users and so many different use cases together that I think it gave issuers a lot more sort of room to work in terms of constructing portfolios that allowed them to kind of get to the performance they wanted. And I think some of that flexibility has been constrained a bit just by the nature of the market and how it's evolved. What do you think about that theory?
Yeah, a great question. So maybe a couple of things. One is when you look at where the growth in the credit card sector is coming from in terms of new originations, and you look at it by vintage range, you're seeing a lot of growth in superprime, so the lowest risk Vantage score ranges, and then you see a lot of growth in the like subprime and near prime categories as well. I think the super prime side, I think, is pretty straightforward. There's a big land grab going on between Chase and Amex and Capital One for that like super premium kind of transactor reward space, right? You see it.
These are the ones where the card annual fees keep going up and all that kind of stuff.
Yeah. You see the annual fees going up. You see the perks and everyone's got a burgeoning network of airport lounges. Right. There's definitely a competitive land grab going on there. What I think is happening on the subprime side is, one, there's a lot of competition in that space. That's where a lot of the fintech oriented card issuers play. And one of my arguments on the sort of relative safety of credit cards has always been that, look, we all need credit cards in American society in the year 2026. We need it to shop online. We need it to rent cars and book hotel rooms and that sort of thing. But if I have 5 credit cards already, I don't know that I quote unquote need a 6th one or a 7th one, right? So as the market continues, as the subprime side of the market continues to grow, I wonder if the affordability challenges that we know that that sort of segment of the country is facing, it's not yet maybe showing up in delinquency, but it might be showing up in people taking on more liquidity, basically by taking on these like additional cards. And so again, like the credit card market in general and subprime in particular has done very, very well for a very long period of time, right? But I do wonder whether that's, again, maybe an initial indication that some of the affordability issues might be creeping in.
Yeah, that would make sense because, I mean, the credit cards are one of those few tools where it actually can be like a proactive liquidity solution where it's like loading up on liquidity is actually, I think it's harder than it used to be in some senses because a lot of the product innovation has been sort of designed to like sort of stop people from doing that. And so credit cards are kind of in some ways the last bastion of like, hey, I don't need it now, but I might need it in the future. So definitely something to keep our eye on and a good lead in to collections, obviously, because all of these things that we're describing impact the way that collections organizations think, the way that they plan. Dave, I've always said that, and I'd be curious to get your sort of origin story, getting involved in collections and see if it matches up with this. But what I've always noticed is that it's one of the kind of sneakily most like sophisticated and challenging areas to work in terms of blending like science and art and sort of finding the right balance between those two things. And, truly some of the like smartest, most creative people in lending who I've ever met have like worked or spent a lot of time in collections. And yet at the same time, it's also one of those areas that organizations have a really hard time investing in proactively, especially in a situation like this where it's like, is it good? Is it bad? Like, we're not even sure like what the data is telling us. And so, no, you don't get an increase in your technology budget to invest in X, Y, and Z. So maybe start with kind of your personal history in collections and your sort of origin story, and then would love to kind of segue into a conversation about what's happening in the space right now.
Sure. The year was 1999. I had been at Capital One at that point for 6 years.
Okay.
Before I had been doing kind of typical Capital One business analyst nerd work, right, around credit policy, marketing optimization, that sort of thing. And my manager at the time said, "Hey, I'd love for you to consider this role leading recoveries, which is basically everything post default or post charge off." Of course, that was over in an operational role, which I had never had. I wasn't surrounded by other business analysts and statisticians anymore.
So did you think you were getting fired, basically? Like, is this a way that they're like trying to push me out of the organization?
Exactly. So you're sending me to operations. Gosh, that's a very creative way to fire me. But yeah, so but again, as my manager described the opportunity, it was a lot of the things you just mentioned. It was this really it really matters to the company's bottom line, especially a company like Capital One that was so indexed at that point in credit card.
Sure.
Second, strategy and analytics and data all really, really matter, right? And we'll talk more about that as we get deeper into it. But then, there's also this very important like human aspect of it, right? Especially at that time, you had these huge call centers, both internal call centers and external call centers. You had a lot of just like organizational messiness in terms of like how collections get structured and how it fits into different parts of the organization. Both from a like analytics and strategy perspective, as well as a leadership perspective, it was a great opportunity, and that's what kind of began my many-year journey in collections. So it was a great opportunity, and it's something that today I'm with, of course, Second Order Solutions, and we do a lot of collections advisory work. I lead our collections practice area, so it's been a 20-year journey for me.
Well, before we get into the kind of current moment, I am curious, like, did you have a moment early on when you were kind of working in that space that was sort of like a light bulb moment in terms of how collections is different? Because one of the things I've always been fascinated with, to the point you were making, is, and Cap One's probably the perfect place to have learned this lesson and maybe been a little bit surprised by this. Yeah. Like, collections, as you say, benefits enormously from analytics. But I would also say it is one of those areas where the analytics does run into human behavior in a way that maybe is a little frustrating to people who only live their lives through like models and thinking about statistical probabilities, right? Like, human behavior is messy. And, things we've talked about in this series so far are things like, the shame of debt and how that impacts people's behavior, and the sort of cognitive load that people are carrying around and how that changes like their ability to manage repayment strategies. Like, there's just a lot wrapped up in collections that, it kind of reminds me of the stock market, right? Where it's like you have people who study the market sort of from a sentiment perspective and people who study the market from like a data perspective. And the reality is somewhere kind of mashed in the middle. And I think in lending, collections is kind of that same thing, where it's this collision of analytics and strategy and operation and technology with like the messiest possible version of like human to human interactions. Did you have any like early learnings or observations when you were kind of taking your Capital One analytics nerd training and applying it to this area?
Yeah, one of the things that Capital One was built on and continues to have as a competitive advantage is having an infrastructure that is set up for A/B testing, multivariate testing, et cetera. And even back then, in the late '90s, the you know what marketing pieces to send to which segments, testing different product structures, testing different price points. The machine was built, and the machine, like the testing machine, worked extraordinarily well. You go over to collections, and there was no testing machine, and it certainly didn't work well. Where even relatively straightforward things like, I want to call this group of people once a day and this group of people twice a day. I want to offer a payment plan with a 0% interest rate to this customer and a 9% interest rate to this customer. That one, it was difficult, bordering on impossible from an infrastructure perspective. The tech at that point just wasn't, it just wasn't designed for that. But then, more importantly, you had all of these thousands of human beings that were, all about supporting the company, all about doing the right thing. But like every test became like a change management issue of I've got to explain the test to all of our call centers and all of our BPOs that are handling the outside calls. And so the testing machine, if you will, again, had both like the kind of quantity and kind of tech aspect to it, but then this really real like human change management piece.
Yeah, I think it ties actually to where we're going next in terms of, because I think AI is probably going to come up in this conversation, but I think about that in the context of AI a lot, where it's like, hey, we want you to use this AI and have it sort of sit next to you and work in these different ways. But don't worry, don't be threatened by it. It's definitely not going to replace your job. There is a change management element to, I think, applying any technology in these areas. And it is heightened emotionally in collections where, to your point, another thing I think people maybe underappreciate a bit is like the people who work in collections call centers, like if they last more than like 6 weeks, it's because they like this type of highly emotional, high stress, trying to drive to good outcomes type of work. It's not for everyone. And, the people who last in those jobs, like take that responsibility very seriously. And so I do think, again, as we talk about like how technology and AI and some of these stuff is changing all of this area, like having that human lens on it is really important. So, before we started recording, you had mentioned that you actually, as the head of Second Order Solutions collections practice, you just got back from a couple of collections conferences. So despite being a collections nerd, I did not get a chance to go to these conferences, which I'm sad about. So tell me, like, what were people talking about? What's hot right now?
Yeah, well, you'll be shocked, given I'm an avid listener of Fintech Takes. You'll be shocked to hear that AI was the hottest of the hot topics. When you think about AI in collections, it kind of fits into two broad categories. One is what I'll call collector-facing AI use cases, which is it's an agent co-pilot, used for quality assurance, et cetera. It's all of the like generative AI platforms and tools that help the collector to be more effective and more efficient. Then the second category is like what we often think of when we think of AI in collections, which is like the consumer facing side of it, voice bots and chat bots and that sort of thing. And of course, on the exhibit hall of the RMAI conference, both were highly represented. Where we are at the moment is, I'd say the agent or collector facing use cases are a bit farther along, not just from a technology perspective, but from a like lender comfort and adoption perspective, where, given that, again, by definition, the collections team is working with customers who are in hardship and who are in financial distress, there's some understandable like reticence to go too far, too fast on the like agentic AI sorts of use cases. But it's, it's definitely a hot topic. And, depending on are you a lender? Are you a collections agency? Are you a debt buyer? Frankly, who is your regulator? Like that tends to like somewhat determine like how quickly and enthusiastically you're pursuing some of these AI use cases. And so, but yeah, it's definitely been a big area of focus for the industry and lots of new providers in the space.
That's interesting. Yeah, I mean, a couple things on what you said. One, it has been really interesting to me because I'm trying to think of the right way to describe this. I think fintech founders are sort of allergic to things that they think are boring. And I think so they stay away from areas that could benefit from new technology or new sort of product thinking, new infrastructure thinking, because they're like, I don't want to do that. That sounds really boring, which is a very understandable reaction from a 26-year-old. However, I think AI has sort of changed the calculus that fintech founders have a little bit. And it sounds like you saw this at the show. I have seen a tremendous number of like founders, startups, like kind of early stage stuff, taking AI and saying, okay, now that we have AI, we might be able to tackle this area that we otherwise never would have touched. And I'm seeing it a lot in compliance. There's a lot of AI for compliance, and there's a lot of AI for collections. And, I'm curious, you mentioned the sort of different risk tolerance levels for different types of organizations. We had John McNamara, formerly of the CFPB, on an earlier episode, and he was kind of talking about Reg F and kind of the regulations that sort of govern collections at kind of a federal level. And it was really interesting because the original regulation, as is the case with so many regulations, was written in the 1970s. It uses the word telegram, and so like it's not exactly modern in that sense, and it certainly did not in any way sort of foresee or think through like the idea that you could have like a LLM powered person essentially either proactively reach out and call a customer, answer when a customer calls. And like, I mean, even when the CFPB recently kind of refashioned the rules for Reg F and kind of the implementing regulation, I still, that was kind of pre LLMs to a degree. And so I guess I'm curious, maybe starting with the customer facing use case, like what are the most sort of like aggressive or sort of interesting implementations you've seen or heard of on that front? It sounds like for the most part, it's coming from like more on the fintech side, or maybe in some of these like kind of less regulatory, high risk areas. But like, if I wanted to implement it in the most sort of like tech forward, leaning into everything LLMs can do well, what would I be doing right now on the customer facing side?
Yeah, for sure. Yeah. I mean, first of all, just to affirm what you're saying, like, of course, Reg F, which John was one of the architects of, was the sort of long-awaited revision or update to FDCPA, which was the one that had, Pony Express and telegrams and that sort of thing in it. But you're right. I mean, and this isn't a criticism of Reg F. It's just where we are in our world today, that while Reg F did contemplate digital collections, like outreach of, via email or SMS or what have you, it didn't really contemplate, what true agentic AI would start to look like. And, again, RMAI is sort of this, like the preeminent collections conference out there. And so like 2 RMAs ago, like February of 24, that was the first time I had ever seen a demo of one of these kind of voice bots in action. And it was clunky and, it hallucinated from time to time, but it was still like very eye-opening. And fast forward a year, and what was interesting was that it was not just better, but it was all of a sudden it became a very competitive space, right? Where like it was a great application for this emerging LLM technology and the associated use cases. And now, just as I was there earlier this week, it's remarkable both in terms of the way that it's progressing as well as the way that it is either beginning to be adopted or it's at least on people's 2026 roadmap. And so it's definitely an area of significant interest. I think that you're right. The one, because Reg F didn't contemplate it, and two, because of just where we are broadly in terms of sort of the regulatory system we have in the U.S. these days. Like, there isn't a lot of guidance either that exists or is forthcoming related to, hey, what's the rule book here in terms of how this information gets used? But
I wouldn't count on the CFPB coming in anytime soon and being like, hey, we've been like really studying the space and like here's some really clear guidance on how to engage with this stuff. Like, if you're holding your breath for that, probably not.
No, I mean, I think it's more likely that the states step in, which then I would argue is almost like more challenging for these fintechs, because you've now got dozens of different state regs and that you've got to account for.
Well, and they're different, right? Like Texas is saying go for it, and New York is saying like under no circumstances. Like you're not going to get the same answer.
Yeah, exactly. But I mean, one thing I'm very curious about, like if you think about the way lenders work with their panel of collections or recoveries agencies, they'll say something like, look, for buckets 4, 5, and 6, I'm going to have 3 different agencies that I use. And I have this dynamic business shift criteria where, the leading agency gets 70% of the work. And then I've got these 2 others that serve as challengers. And if they can outperform the incumbent, then they get more of the work, et cetera. So I don't think we're that far away from that same dynamic existing on the collections voice bot side, where, you've got, bot providers 1, 2, and 3. All of them are good and all of them are getting better. Some of them are going to work better for certain segments, for, different asset classes, et cetera. So that rather than a bank declaring, okay, such and such AI company is the official AI provider of my bank, they'll end up with multiple relationships, and just the same way they do with agencies, right? What that will do is that'll lead to better performance for the banks, but then also margin pressure for the AI providers, right? Because now, even though their business model is a lot more efficient, part of the criteria of whether you're the champion or the challenger is going to be the expense side. And so I don't think we're many more conferences away from that kind of dynamic.
Well, that's interesting, and it's a good observation, right? Because you see this in like the alternative credit data space, you see it in fraud, where it's like there's a good position to be in, which is to be like the orchestration infrastructure that facilitates these constant bake-offs. And then there's the bad position to be in, which is to be in the bake-offs and constantly like trying to keep your place in the waterfall or keep your allocation of the cases that you're getting assigned from a collections perspective. And I think you make a great point about the margin pressure, because I'm still not totally clear on the cost side of this stuff too, right? Like if you're getting squeezed from a pricing perspective, but at the bottom you have inference costs that are not overly flexible, like it doesn't leave a lot in the middle. And so I'll be curious to see how that space evolves. I'm also curious, and you worked in collections, you ran these shops at Capital One, like what do you think the value is, or how customers are going to respond to this? And just to frame out this question a little bit, I think it's interesting because on the one hand, like I totally get it, right? And I would compare it to like IVR. Like IVR is just terrible. And the more that you try to make IVR sort of pretend to be a human being, the worse it gets, right? Where it's like, tell me why you're calling. And then I say exactly why, and it doesn't understand what I'm saying. So on a baseline level, like using LLMs to just be like a more flexible communication layer for voice relative to the way we do it now, like it seems to me there's some very clear wins there. However, the flip side that I think is interesting is the virtue, and this is something I know you've spent a lot of time on, like the virtue of digital collections channels in a more classic sense. So like email, text message, whatever, is like it's self-service, it's convenient whenever I want to use it, and it kind of completely avoids talking to human beings, which if I'm dealing with something that I'm embarrassed by or that I don't really want to like talk to a human being about, then like there's the value is not talking to a human being in a lot of senses and just resolving a thing in a very mechanical way, in a way that's convenient for me. On the flip side, on the other end of the spectrum, you have obviously like human agents. And with human agents, like you're going to run into the shame and the annoyance of talking to a person. And maybe I'm just, 19 years old and I don't know how to talk on the phone and I don't want to talk to a human being. So like there's all of those problems, but actual live human beings, I know I'm talking to someone, they can convey a sense of like empathy through the phone. They can help me feel less ashamed. They can maybe even take a more kind of global approach to helping me think through like, I'm in this crunch right now, but how do I dig myself out of it? Oh, here's how our payment plan can be a part of what you're trying to do, and encouraging and getting promises to pay and all that kind of stuff. This is going to be the overly critical way of describing where AI voice sort of sits. I kind of think it maybe sits in the middle in a way that's not very helpful, because if you're like wanting like clean, quick self-service, then any attempt by the AI voice bot to be like empathetic or to like draw you into a conversation is just going to be like annoying and not that useful. But if I want like empathy and like a conversation, wouldn't I quickly sort of want to distinguish between I'm talking to an actual human versus talking to voice? So like, how do you think consumers are going to react to this and like getting a call, and the first part of the call is, hi, just so you know, I'm an AI voice bot, but I'm here to help. Like, what do you think the consumer experience is going to be?
Yeah, great question. I mean, one of the things that you alluded to that I want to sort of underline is like the behavioral psychology of the delinquent borrower. And there's this complex, and because frankly, I think that's an underexplored area within the industry is the just exhaustion that delinquent borrowers feel. Because again, they're usually not just delinquent on one loan, they're delinquent on most or all of them. The frustration that comes from that, as you say, the shame that comes from that. And actually in my conversations with some of these AI providers, they view that as a feature, not a bug. Like the fact that you're not talking to a human, they view as like that can actually be a good thing for a lot of customers, because they would rather hash through these difficult conversations without actually having to speak with someone. Now, so again, that's not universally true, but that's
no. Yeah. Well, but that's interesting because, and I'm sorry to interrupt, but like just to pull on that thread. So the theory of the case might be something like, this is a complex conversational sort of resolution. Like it's not just like, hey, I need to like make a payment, which is kind of the like easy self-service. So the theory would be, this is one where I do need to like give a response, get an answer, like explore like what options are available in a way that's easier to do over a conversation. But the shame that I feel, or my just sort of reluctance to talk to an actual human being, might make AI a more approachable place for that conversation. Is that the theory?
Yes. And I think, again, it's early in the game to know how that theory plays out. But I'd like to think that one, and this is a common practice that I hope becomes a universal practice, is to make it super easy to, when the bot says, hey, I'm a bot, let's just agree that we'll make it easy to pound out to a human. Because gosh, at that point, you've got a consumer on the phone. Like that's a huge win. Yeah, you're there. That's why you exist, is to actually communicate with customers. So gosh, let's find a way to make that a standard practice. The other thing I could see, back to your like channel of choice argument, is because we're seeing this in general across collections, is rather than an auto dialer / IVR, which is managed by one team, which is on a completely different platform than your online portal and your outbound emails and SMS. Like, let's blend that together so it's more coherent, right? And you can imagine, for example, and in your example, I'm on the website and a chat bot pops up and says, "Hey, obviously we can chat." Or, can I call you? Phone number ending in 1234, and then you're giving the customer the agency to say, "Yeah, sure." Like, now by definition works for me because that's why I'm on the payment portal. So there might be ways through that sort of cross-channel journey development in order to, like, rather than it being stuck in an uncomfortable middle position, potentially have it be the best of both.
That makes a lot of sense. And it's something that our friends at C&R talk a lot about, right? Is like sort of developing that single pane of glass, like switchboard-esque infrastructure. And I think you're right. Like, this is clearly a useful tool, right? I mean, I think anyone, like, there's probably no one who disagrees with the statement that, like, this ability to have an intelligent, flexible, voice-oriented way for the customer to communicate that's not a human being, but can get them quickly to a human being if that's where they want to go, or can help answer their questions, or just, honestly, I mean, you might see some weird emergent behavior. You might see them just chatting too. Like, I mean, I think that's the other thing that's kind of funny about collections is, human collection agents, their performance is measured by how many calls they get through, right? And so there is a little bit of that, like, okay, is there anything I can help you with? It's like the waiter coming to the table and being like, just checking, is there anything I can do? Like, you feel like you're getting kicked out of the restaurant. And you might see some strange, interesting emergent behavior where people just stay on the phone with these AI collection agents, just talking about their problems. Like, I mean, I don't know. Like, I think that's what makes it so interesting. Dave,
just a quick aside. I had a mind-bending experience about 6 months ago where I heard my first bot-to-bot communication.
Did you really?
So there was a bot on the lender side, which was doing collections, and then there was a bot on the debt settlement company side. Someone like Freedom Financial, JG Wentworth, et cetera, who was, who have bots calling the lenders to negotiate settlements. And that was like a big life moment of like a harrowing glimpse into the future of not just collections, but my life as a human. So,
well, I mean, no, totally. That is going to be the most interesting, is when bots on both sides. And you can imagine we're not that far away really from, like, me being able to task ChatGPT to deal with these collection bots that keep calling me, right? Like, I mean, like, this is not like science fiction. This is like right around the corner. And, the early returns, I don't know how the interaction you witnessed went, but one of the things that I think is really funny about it is they're so polite to each other, at least in these early days, where they're like, "Thank you for calling." "No, thank you for calling." They just, like, they go back and forth in the most polite, sort of like socially conscious way of interacting that you've ever seen. But it really is truly fascinating to me, because you could imagine, again, in that scenario, like, your strategies have to totally change, right? Like, if you are a collection shop, but like 40% of the people you're trying to collect through won't talk to you, they'll make you talk to their agents that they have working on their behalf. Well, then you have to, like, program, then all your knowledge about the psychology of human beings and how they make decisions and how to sort of nudge them or sort of like lure them into different areas to get the resolution you want. Like, all that whole playbook has to get thrown out the window. And now we're programming against computers and against bots. Like, that's probably a little too sci-fi to spend more time on, but, like, I'm glad you mentioned it, because that is deeply interesting.
Yeah, for sure.
All right, before I let you go, setting aside everything we've been talking about, digital AI, all this optimization stuff, I'm curious, on maybe a more fundamental level, some areas that you think there are opportunities for banks and for other lenders as it relates to collections. Because I think, going back to a comment I made at the beginning, this is one of those areas where it just doesn't get a ton of investment. And, like, I think the beautiful thing about that is there's still a lot of, like, really like essential, almost low-hanging fruit, like things you can do that don't depend on like magic tricks from AI in order to get better? Like there's still like fundamental areas of improvement. What are some areas you would highlight based on the conversations you have?
Yeah, great. Yeah, a couple come to mind. One is I think every head of collections should have a head of data. Some of that is data sciences, so building propensity models, channel preference models, et cetera. But it is also just all of the different external data sources, but then also internal data sources that can be used to optimize and design the right kind of customer journey. The thing about bureaus is that almost by definition, by the time someone gets to collections, their credit score doesn't look great. So you need way more than that, right? And so like trigger-based collection strategies like, hey, you've charged it off on 6 credit cards, say 2 to 3 years ago, but now you just settled in full on one of them. Well, now your understanding of that customer's ability to pay is totally different. You had Chris and Doug on a few episodes ago talking about cash flow data and all of the use cases there.
Cash flow servicing is like my passion project right now. Totally.
Yeah. And so, using cash flow data to assess ability to pay, and again, using like sudden improvements in cash flow data or sudden like deterioration in cash flow data as a signal, kind of one way or the other, that the customer's financial situation is changing. But then on the internal side, there oftentimes in a bank, there's a centralized collections team that support all lending products. So auto loan collections, credit card collections, personal loan collections. And that just creates a really difficult set of data challenges around what are the early warning indicators that I'm getting across multiple lending products, and how do I bring all of those to bear as potential features in my collections models. So again, one would be like have someone whose job it is not just to do the modeling with the data, but to put your institution like best in class when it comes to actually like aggregating and harnessing the data. The second is to have a head of marketing. In a world where like we've moved over the last 10 years from phone first with some mediocre emails to like it's all about digital, it's all about the web experience. Oftentimes the people that lead collections are either sort of credit people like myself, or lifetime kind of call center operations people. Yeah. So I think the discipline of marketing, like multi-channel marketing, is just way unexplored in most collections areas, and is just becoming more and more important as digital becomes more dominant. And then if I could just throw in one more pet peeve.
Please.
Often lenders have what I'll call a co-management model of collections, where usually there is a head of collections operations who manages the internal associates, manages the external agencies and suppliers, and that person reports up to the COO. Then there's usually someone that either reports into the business line or reports into the first line credit team that is responsible for the strategy, the analytics, the modeling, the settlement guidelines, those sorts of things. You can probably see where this is going. Like that often doesn't work, right? Because essentially you have two very different parts of the organization with very different sets of incentives imposing on the same organization effectively. Yeah. And so I think it's a best practice for, again, it's going to sound really obvious as I say it out loud, but like think of collections as a business line with revenue and expenses and infrastructure and tech, and have a single leader accountable for the performance of all of it. There are some banks where that's just blasphemous, and in that case, like if you're going to have a co-management model, just make sure that there's a unified sense of team with a unified set of goals, and even things like have the same set of management reports, right? Have the same, like don't have an operations management report that goes up one organizational silo and a credit one that goes up the other one. At least be clear that, hey, here are our collective challenges. Here's where we're collectively doing well. So again, this gets back to where we started, which is some of this is really analytically nuanced and strategically sophisticated. Some of this is just having the right people in the right seats. And that's one thing that I'd love to see changed.
Those are great. I mean, the marketing one is one that has come up in previous conversations too. And I had never thought about it until it started doing this series. But the idea that like collections suffers from a marketing problem where really like your goal is to convince people to do things, like that actually makes a ton of sense. And I think we don't invest nearly enough in those resources because we just think of collections as an ops problem or as a data science problem. And we don't think of it as a marketing, a customer engagement problem, even though we should. And I think to your point about the organizational stuff, I mean, to me, I would even take it a step further aspirationally. And this is like probably going too far, but like, I would like a head of servicing that oversees everything after origination through servicing. Like, because I think the distinctions we draw between servicing and collections are completely bizarre and are totally disconnected from the way that consumers experience working with our institutions. And it goes to your point about the reporting as well. Like at the end of the day, you have to have a philosophy for what metrics you care about that you're trying to drive an improvement on. And, one of the kind of theses of this entire series is that, as customer retention and as lifetime customer value, like as those metrics become more important, you have to look at parts of your organization, like your call center for collections, in a completely different light. Because if you don't, you are leaving money on the table and an opportunity to improve some of those core strategic metrics on the table by thinking of this only as an ops problem or only as a data science problem. So I couldn't agree more with you.
Yeah, absolutely. Yeah, it's a fascinating area, and I'm just real excited about the future of collections. I feel like if AI in collections right now might be just a tiny bit overrated in terms of like where the money is going to be made, this year and next year. I think areas like digital, like cash flow underwriting data, like you don't have to imagine, like it's there in front of us, right? And I think there's great opportunities there, both in the short term and the long term.
I totally agree. And we'll have to have you back in the future to check in on our progress as an industry toward all of these things. Dave, thank you for joining me. As always, a delight.
Thanks a lot, Alex.